Hello everyone. This will be the final chapter in BT 10103 Financial Management. The topic is the cost of capital. So the objective of this chapter is at the end of the day, you should be able to understand the concept underlying the overall cost of capital. The key word is the cost of capital, and what's the purpose for its calculation? Okay, purpose of calculation. Secondly, moving forward, you should be able to evaluate the firm's capital structure and determine the relative importance of the weight of each source of financing. Okay. Number three, then you should be able to calculate further details on the cost of debt, on preferred stock and common equity. All these three is a component of the firm's cost of capital. And finally, should be able to calculate the overall WACC, the weighted average cost of capital. Step of So let's look at the overview of the cost of capital. So we can view the return that investors expect to receive on the firm's stock and bond as the cost of the firm. This is the cost of the firm. So basically, the idea of if you want to understand what is the cost of capital is that we go back to the balance sheet of the company. I always draw this balance sheet for you to understand where is the position of the chapter that we're going to discuss. Okay, so this is a balance sheet of the company. Okay, balance sheet. So this chapter is actually looking at the funding side of the companies. So we talk about the equities and sorry, we talk about the liabilities, okay, and the equities part of the company equities. So among the items under the liabilities and equity is the loan, the debt or the bond, and also the share. The share can be in the form of preferred stock, preferred stock, or the ordinary stock. Okay, so the basic idea of the cost of capital is that if the company raise a capital in the stand of liabilities or the equities, it comes with costs. So in this case, loan is excluded in the calculation of cost of capital because it's a private debt. Okay, but a public debt and also a public fund, so it will include in the calculation of the cost of capital. So we are talking about the cost of the debt, okay, the cost of the preferred stock and the cost of the ordinary stock. So basically the idea is that the cost of the debt come from the coupon rate. The cost of the preferred stock is the cost of the dividend that the company has to pay to the preferred stock holder, and the price of the return of the share, ordinary share, is also a cost to the company when the company decide to raise the capital using ordinary stock. So at the end of the day, the cost of capital, or you want to calculate the weighted average of the cost of capital, because we want to determine the cost of all these combination of funding for the specific company. So I hope you understand where is the position of the chapter that we're going to discuss today. All right. So furthermore, we can think of the cost of capital for a firm is the weighted average of required return of the securities. Okay, so as I mentioned to you before, so a return for these different classification of assets here will determine the cost of the capitals. The debt, the cost of the debt is the cost of the coupon rate. Here is the dividend cost. Here is also using the dividends and increase of the company's price of the stock. Okay. Furthermore, WACC, or weighted average cost of capital, incorporate the required rate of return demanded by the firm lenders and investor, along with the mix of financing sources that the firm use. So basically, an overview of this cost of capital sufficient for you to understand that we are discussing what is the average cost of the combination of source of funding by the firm. So after you calculate the WACC, you have the company cost, average of cost of capital. So what is this WACC used for? So we can, looking at the notes, first WACC is used to value the entire firm. Number one, it is used to as a form of valuation for the company. Okay, we're talking about a company with a lower cost of capital means the company value could be higher than a company that is having a high cost of capital. Okay. Secondly, firms often use WACC as the starting point for determining the discount rate for individual investment project they might undertake. Okay, if you remember the previous chapter under investment decision analysis, when we do assessment for the capex decision of the company, we use, say, NPV, okay, NPV, IRR, okay, and other method of assessing capex decision by the company. So the value of, in the case of NPV, the value of the return may come from the cost of weighted average cost of capital, because obviously when the company want to invest, balance sheet, come back again, if the company want to invest in asset, okay, so they will use funding from here. Okay, so it is important for the company to determine what is the cost of funding. That's why cost of funding is also can be determined by WACC. So the idea is that we want to have a higher return here for whatever investment that you made on the asset as compared to your cost of capital. That's why the second use of the WACC is to determine as a discount rate for the capex decision. Okay, so finally, WACC also used to evaluate the performance of the company. Okay, in the calculation of WACC, there are only maximum 3 items, 3 source of capital that we include in the WACC. One is the cost of debt here. Cost of debt. Debt here is a bond. Okay, this is a bond. If there's a stock, cost of preferred stock. Preferred stock. This is another one. Okay, number 2. Then cost of common stock, I mean ordinary stocks, number 3. So 1, 2, 3. 1, 2. Although in the funding side there are also loan here, okay, but loan is not included in the calculation of WACC because it's considered as a private debt. So the cost of loan is pretty specific. It's already there. So the company pay a very tangible numbers of interest. That is the cost of loan. So in the WACC calculation of WACC, only 3 items that will be taken into account. 1 is the bond or the debt. 2 is the preferred stock, and 3 the ordinary stock. So what happens is that weighted average cost of capital is basically you only multiply the cost of each of these component to its weightage, the proportion of capital raised by the debt. So if you add up all this proportion, this one, proportion of this thing, it should be going into 1.0. It's only a weighted components of this component as compared to the total amount of capital. So basically, this is a template for calculating the WACC. It's basically the more organized ways of you looking the previous formula. Here, as you can see, there's a component of debt, the bond, preferred stock, and common equity. So what happened here is we calculate first what is the weight of each of the component. This one W for preferred stock and W for common stock. So you just multiply by its cost. So in the case of debt, the cost is the cost of the coupon, okay, and here is the cost of the preferred stock, and this is the cost of common equity. All right, you just multiply the weightage and the cost, except for debt, okay, where the K, the cost of debt, you have to multiply to the 1 minus tax. 1 minus tax, because the coupon payment is before tax in the profit and loss. So you have to exempt, or you have to minus the component of tax. All right, here. So you can read further details on the description of each of these items in the notes. Okay, this is further explanation or elaboration on how you determine the firm's capital structure weights this way. So basically, I think I already covered it a bit in the previous slides explanation. The only thing is that you have to make sure, or you have to take into account that when there are two values of the debt, we always use book value for debt and market values for equity. Okay, so in the case of bond, we always look at, or we use book value. In the case of preferred stock or ordinary stock, so you have to look at the question and use the market value as the cost calculation in the WACC. So now we have an example of how to calculate the WACCs. Okay, look at the problems. Okay, the problem states that after completing her estimates of Templeton WACC, the CFO decided to explore the possibility of adding more low-cost debt to the capital structure. Okay, so with the help of the firm, investment banker, the CFO, learned that Templeton could probably push it use debt to 37.5% of the firm capital structure by issuing more debt and retiring or repurchase the firm preferred share. So they could be done without increasing the firm cost of borrowing or the required rate of return demanded by the firm's common stockholder. What is your estimate of the WACC of Templeton under this new capital structure proposal? So first you have to understand the question first. So basically this is a question of WACC. So what is meant by this question is that, okay, initially the company has three component of capitals. One is the preferred stock, there's a debt, and there's also ordinary stock. Okay, so what happened is that they want to retire this one, the preferred stock, by issuing more debt. So more debt. So this debt, the issuance of debt, will buy over the portion of the preferred stock. So what happened later is that the company capital may exist only two type of source, which is debt and the ordinary stock. So in order for us to evaluate either this new approach will put a company in a better position is to calculate what is the WACC of the proposed capital structure. What is the WACC? So you compare the WACC between the initial capital structure as opposed to the new capital structure, this new capital structure. So if the WACC, the new WACC here is smaller than I mean it's smaller than the all WACC, then this approach should be adopted. Okay, this is as I mentioned before. So this is the initial capital structure of the company. The company has three sources of capital, which is the debt, the preferred stock, and the common stock. So what happened next is that the new proposal will increase the common stock, or at the end of the day, there will only two source of capital, which is the debt, and the common stock. Okay, using the same problems, there are further information given. We can see here that there's the cost of debt is fixed at 6%. Okay, while the cost of the common stock will be 15%. Okay, so how do we calculate weightage of each of the component of the capital is by dividing it over the total cost of capital. So in this case, it is also determined here that the weightage of the debt is 37.5%, while the weightage of the common stock is 62.5%. Furthermore, there's no information on the tax. So on the tax even. So if there's a tax, say 30% tax, for example, if there's a tax information, so the cost of debt should be 6 multiplied by 1 minus 0.3. But in this example that adapted by from the books, there's no, I believe there's no information on the tax. So by using the formula of the WACC before this, so we can just plug in the numbers. Okay, so it is easy for you to put it in the template. So what happened is this: we take the debt, the weightage of the debt is 0.375. Just multiply by the cost of the debt. If there's a tax, so you minus 1. Multiply 1 minus tax if there's a tax information, but in this case there's no tax. So you multiply weightage over the cost, so we get 0.0225. 225. So calculate it's in the common stock. The common stock weightage is 0.625 multiplied by 0.15. We get 0.09375. Because there's no preferred stock, because we retire the preferred stock. We retire, so there's no component of preferred stock. So you just add up these two items, we get 0.11625 or 11.625%. All right. So it was not given before that actually the cost of capital when the company has the three component of capital was previously is 12.125%. So we calculate the new structure is only, the cost of capital is only 11.625%, which is cheaper than this one. So basically it is a good approach to be adopted by the companies. Right. So previous slide is actually a simple ways of how you calculate WSEC, where all the information is already been given. But there are also a case or questions where you have to calculate the individual cost of the capital. What I mean is that in the previous slide, the cost of the debt is already given. The cost of ordinary stock is also given, as well as the preferred stock. But there are questions that is requiring you to calculate what is the cost of each of the component of the capital. So the next slide is discussing how you calculate the cost of each of the capital. All right. If you look at the components of the capitals, say debt, they also preferred stock, and ordinary stock. Ordinary stock. So the cost of each of these component is already been discussed in the previous chapter. Okay, you remember that in the previous chapter on the debt valuation. So the cost of the debt is simply what the YTM of the debt, YTM of the bond. So in this case, there are certain questions that is where you are not given the information of the coupon, the cost of the debt. So in that case, then you have to use the formula discussed in the previous chapter of debt valuation and calculate the YTM. YTM. So let's look at this. The cost of debt is the rate of return of the firm lender demand when they loan money to the firm. Okay, so we estimate the market required rate of return of firm debt using its YTM, yield to maturity, and not the coupon rate. Yield to maturity, yield to maturity. So basically, when you look at the cost of the bond, okay, so what is the YTM, the discount rate for the present value of the bond? We're talking about this thing. So quite quite lengthy and quite lengthy process when you want to calculate the YTMs, because it is a try and error. So if you are using the financial calculator, then it will be a simple exercise. Okay. Okay, here is how you calculate the cost of preferred equity. If you remember, during the previous chapter in the stock valuation, we discussed about how to evaluate or how to calculate the valuation of the stock. So one of which is the preferred stock. So this is the if you can remember the previous chapter in the stock valuation, you calculate the rate of return of the preferred stock by using the perpetuity formula. This perpetuity formula. So you just plug in all the figures in using this formula. Okay, for the common equity, there are also ways for you to calculate what is the cost of the common equity. There are two ways. Basically, there are two ways. You may use the dividend growth model, as we discussed in the chapter 10, and you can also use CAPM. CAPM from chapter 8. It depends on what information that is given in the questions. I think I won't elaborate more on this thing. You can refer to your notes in chapter 10 and chapter 8 before this. Okay, if you look at this formula of based on the dividend growth model, is basically the original piece is from the stock valuation formula. If you remember the chapter, I think chapter 10 for this. So this is basically the stock value, which is the price, is equal to D01 plus G divided by R minus G. So basically if you this formula is derived from this formula. So you just adopt the this formula for calculation of the cost of the common stock.